Right now, millions of Americans believe they are doing okay financially. They pay their bills, they swipe their credit cards, they make the minimum payment every month, and yet they are getting poorer. Not suddenly, not dramatically, but quietly. This is not because Americans are lazy. It's not because they don't work hard. And it's definitely not because they are bad with money. It's because the system is designed this way. Let me ask you something. If credit cards are supposed to help people, why is credit card debt in the United States at an all-time high? Why are banks reporting record profits, while households struggle more than ever? This is the credit card trap, and almost nobody explains how it really works. Credit cards were sold to Americans as freedom. Buy now, pay later. Build your credit. Earn rewards. Emergency safety net. It sounds responsible. It sounds smart. But here's the truth most people don't realize. Credit cards were never designed to help you win. They were designed to keep you inside the system. Banks don't make money when you pay your balance in full. They make money when you don't. Interest, late fees, penalties, compounding debt. That's where the real profit lives. And the system is engineered so that not paying in full feels normal. It usually starts small. A medical bill, car repair, unexpected expense. You swipe the card and say, I'll pay it off next month. Next month comes, and life happens again. So you make the minimum payment. And here's the first invisible trap. The minimum payment is not designed to help you pay off debt. It's designed to keep you paying as long as possible. On many cards, the minimum payment barely touches the principal. Most of it goes straight to interest, which means even when you pay, your balance barely moves. But psychologically, your brain feels relief. I paid it. I'm responsible. I'm okay. That feeling is dangerous because it keeps you calm inside a system that is draining you slowly. Banks don't want reckless customers. They want disciplined people. People with jobs. People who pay on time. People who don't panic because those people stay trapped longer. A borrower who defaults is a problem. A borrower who pays minimums for 15 years is a gold mine. That's why credit card offers are targeted. High limits, low introductory rates, reward points. The goal isn't spending once. It's spending forever. Here's something nobody tells Americans clearly. Credit card interest is one of the most powerful wealth transfer tools in the modern economy. Money doesn't disappear. It moves. Every month, interest moves money from households to financial institutions. And because interest compounds, the longer you carry debt, the faster that transfer accelerates. You are not standing still. You are moving backward, slowly, invisibly. And the scariest part? Most people don't notice until years have passed. If credit cards are so harmful, why does almost everyone use them? Because the system is built around them. Rent, subscriptions, gas, groceries, online shopping. Cash feels outdated. Debit feels restrictive. Credit feels normal. And rewards programs make it worse. Cashback, miles, points. Your brain focuses on the reward, not the interest. You feel like you're winning. But the bank already ran the numbers. They know the average user will pay far more in interest than they ever earn in rewards. Debt doesn't just affect money, it affects decisions. People stay in jobs they hate because of balances. They delay investing because of payments. They avoid risks that could improve their lives. Debt creates financial fear, and fear creates compliance. A population in debt is easier to control, easier to predict, and easier to profit from. This is not conspiracy, it's math. Americans are told that having credit card debt is normal, even healthy, like as long as their credit score is high. But here's the uncomfortable truth. A good credit score does not mean you're winning financially. It means you are useful to lenders. You can have a great credit score and still be broke, because credit scores measure behavior, not freedom. So now the question becomes, if the system is designed this way, who actually escapes? Why do some Americans break free while others stay trapped for decades? In the next part, we'll expose how minimum payments mathematically keep you trapped, why banks push balance transfers, the psychological tricks that keep people swiping, and most importantly, how the smart ones quietly step outside the trap. If you want to understand why millions of Americans stay in credit card debt for years, you have to stop listening to advice and start looking at math. Because the math was never designed to help you escape. Let's break down the most powerful weapon in the credit card system. The minimum payment. Banks present it as relief, a small number, a manageable amount. But mathematically, it's a leash. On a typical credit card with a 29% interest rate, the minimum payment barely touches the balance. Most of what you pay goes straight to interest. The principal and the actual debt barely moves. This means something terrifyingly simple. You can pay every month. You can never miss a payment. You can do everything right and still remain in debt for decades. That's not an accident. That's design. Imagine a $5,000 credit card balance at 24% interest. You make the minimum payment every month. After 1 year, you've paid hundreds of dollars, but the balance barely dropped. After 5 years, you've paid thousands and still owe most of the original amount. By the time the card is finally paid off, many borrowers will have paid double or more of what they originally borrowed. This isn't financial irresponsibility, it's financial engineering. Banks don't hide this information. They bury it in fine print because they know most people won't calculate it. And that's enough. Now here's where the trap gets smarter. When people start feeling overwhelmed, banks offer a lifeline. 0% balance transfer for 12 months. Lower interest. Consolidate your debt. It sounds like escape, but for many people it's just a reset button on the trap. Why? Because balance transfers don't eliminate debt. They relocate it. People feel temporary relief, so they keep spending. The clock runs out. Interest returns. The balance grows again. Banks count on one thing. Human behavior doesn't change just because the interest rate does. And statistically, they're right. Here's something critical most financial advice ignores. People don't make money decisions logically. They make them emotionally. Credit cards remove pain. When you pay cash, you feel the loss. When you swipe a card, the pain is delayed. Delayed pain feels smaller. This psychological gap makes people spend more than they would otherwise, and the bank profits from that difference. Then rewards programs reinforce the behavior. Cashback, miles, points. Your brain associates spending with winning, but rewards are bait. Banks know the average cardholder will pay far more in interest than they ever earn in rewards. The reward isn't the product, your long-term behavior is. In the past few years, inflation quietly turned credit cards into survival tools. Groceries cost more. Gas costs more. Rent costs more. People didn't suddenly become irresponsible. They became cornered. Credit cards became bridges between paychecks. But bridges turn into cages when wages don't keep up. And banks adjusted quickly. Interest rates rose. Fees increased. Limits expanded. More debt. Higher profits. The system feeds on pressure. One of the most dangerous thoughts in personal finance is, I'll deal with it later. Later never arrives when the system keeps pulling you back. Unexpected expenses. Life changes. Emergencies. Credit card debt thrives on unpredictability because life is unpredictable. Banks don't need you to fail. They just need you to never fully win. This is important. Credit card debt isn't a problem of intelligence. Doctors have it. Engineers have it. High-income professionals have it. Because the trap isn't about income. It's about structure. High earners often get higher limits. Higher limits lead to bigger balances. Bigger balances generate more interest. The system scales with your success, which means earning more money doesn't automatically free you. Sometimes it deepens the trap. Here's one of the most uncomfortable truths in American finance. The system praises you for behavior that benefits lenders, not behavior that builds freedom. You can carry balances, pay interest, stay in debt, and still have a great credit score. Because a good credit score doesn't mean you're wealthy, it means you're predictable. And predictability is extremely profitable. Debt changes how people live. People delay starting businesses. They avoid career risks. They stay dependent on steady income. Debt doesn't just take money, it takes optionality. And when millions of people lose options, the system becomes more stable. For banks, this is why credit card debt isn't treated as a crisis. It's treated as a feature. At this point, you should see the picture clearly. Credit cards aren't evil tools, but they are weapons of structure. Used carefully, they can help. Used passively, they quietly drain. The difference isn't discipline alone. It's understanding how the system wants you to behave. In the final part, we'll talk about why some Americans escape completely, the strategies banks hope you never learn, and how people quietly regain control without extremes or gimmicks. This is where the real shift happens. At this point, one question matters more than any other. If the system is designed this way, how do some Americans escape while others stay trapped for life? Because escape does happen, quietly, without drama, without gurus. but it requires understanding something most people never learn. The biggest mistake people make is trying to win inside the rules banks created. Better rewards, lower interest, more cards, smarter juggling. That's not escape. That's optimization inside the cage. The people who get out don't focus on managing debt better. They focus on ending dependence on debt entirely. This is a mindset shift, not a budgeting trick. They stop asking, how do I use credit cards better? And start asking, why do I need them at all? That question alone changes behavior. Most financial advice sounds good but fails in real life. Just budget. Just pay more. Just stop spending. That advice ignores reality. People don't fail because they don't know what to do. They fail because the system pushes them back into debt, unexpected expenses, inflation, income instability. The solution isn't perfection. It's resilience. And resilient systems don't rely on credit to survive. Here's something you rarely hear clearly. The fastest way out of credit card debt isn't chasing interest rates. It's removing volatility from your life. The people who escape focus on emergency buffers, predictable expenses, cash-based systems. They reduce surprises first, because surprises are what push people back to cards. Even a small emergency fund, not a huge one, breaks the dependency loop. Once the card stops being the first solution, its power fades. Some people try to quit cold turkey. They cut cards. They feel disciplined. Then life hits, and they swipe again, because willpower doesn't survive chaos. The people who succeed don't rely on discipline. They rely on systems that make discipline unnecessary. They simplify. Fewer accounts, fewer payments, fewer mental decisions. Complexity is where debt hides. Another lie Americans are fed is that some debt is good and some is bad. Reality is simpler. Debt that increases future options can be useful. Debt that limits future options is dangerous. Credit card debt almost always limits options. It doesn't build assets. It doesn't increase income. It doesn't create leverage. It creates pressure, and pressure changes decisions. Banks don't fear people who pay off balances once. They fear people who don't revolve balances, don't carry long-term debt, don't emotionally rely on credit. Those people become unpredictable. And unpredictability is bad for profit. When someone stops treating credit as a safety net, the entire system weakens. That's why marketing focuses on comfort and rewards, not independence. Here's what most people miss. Escaping credit card debt is not about money. It's about lifestyle alignment. People who escape live slightly below what they can afford. Avoid upgrading life every time income rises. Value flexibility more than appearances. They don't look rich. They feel free. And freedom compounds faster than interest. This isn't just about individual debt. A population dependent on credit is easier to predict, easier to control, easier to monetize. Debt keeps people compliant. It keeps them working jobs they hate. It keeps them avoiding risks. It keeps them silent. That's why credit card debt is normalized. Because normalization keeps the machine running. Here it is, the uncomfortable truth. Credit cards don't ruin lives overnight. They slowly delay freedom. And delay is powerful, because a delayed life looks normal from the outside. People smile. They work. They swipe. They survive, until years pass. And suddenly they realize they traded time for convenience. This video wasn't about demonizing credit cards. It was about seeing the system clearly. Once you see it, you can't unsee it. You stop blaming yourself. You stop feeling ashamed. And you start making different choices, quietly. That's how real change happens. Not with motivation, with awareness. Before you swipe next time, ask one question. Is this purchase increasing my future options or reducing them? That single question does more than any budgeting app ever will. Banks don't need you to fail. They just need you to never fully escape. But escape is possible. And it starts the moment you stop playing a game you were never meant to win.